Hey everyone, Jake Adams CPA here. Just wanted to go through some last minute tax savings ideas and strategies. We're down to the wire here, only another 10 or so days left to the tax filing deadline. So, with that in mind, we want to talk about some tax savings that you can do, some things that are options for you. Now, hopefully, you have these accounts already set up, like an IRA or a Roth or a SEP or 401k or an HSA. If you don't, and you want to take advantage of these, please reach out to me. We can look into this individually for you if you don't have this account set up, because some of these allow you to set up the account afterwards. I think the IRA does, but I'm not sure about this. Oh, the 401k has to be established last year. So that would be 2021, the end of 2021 to put your money in for 2021. But if you have the 401k last year, 2021, then you can fund it up until 415. Actually, I think they're going to do 418. So we have another couple days to get you to Monday. So let's talk about each one of these and the deadline, why you may want to do it, why you may not want to do it, or what the differences are. So let's start off with the IRA, which is the retirement account, right? Just a simple IRA, like most people are familiar with. The deadline to fund this and to open it is 415. If you're under the age of 50, you can do $6,000. If you're over the age of 50, you can do $7,000. Now, once you cross over these thresholds, you lose out on some of the ability to take this, right? And essentially, the phase out starts at these numbers. You start to the amount you can, the maximum amount you can drop that you can contribute starts to drop, and then it gets to zero. So if you're looking at this number and you're like, wow, Jake, I made, well over 150, then you can't do the IRA. We got to look into the 401k or something other for you, right? So be familiar with the IRA, lowest limits, lowest thresholds of income, right? So if you don't have a lot of income, but you still want to put something away, this might be a good idea. Also, if you don't have a lot of income and you still want to put money away, you might also be able to get the savers credit. So if you do want to do this, let me know. Run the savers credit through the software. And if that allows you to do that, you might get a credit for contributing to a retirement account. Okay. We're going to come back to the Roth because the Roth is a little bit different. Now, the SEP is the self employed pension plan. This one, the deadline to fund it is actually 10/15 with extensions. Now, the interesting thing with the SEP, or the different thing that you need to know with the SEP, is it's 25% of compensation. And compensation is different for different businesses. So if you're a Schedule C, then your net income of your Schedule C less the 7% self employment tax. So it's like 93% of your profits you can do to the SEP, right? So essentially, if you did, let's say, $100,000 in a Schedule C, 93% of that would be 93, and then 25% of that would be about, I don't know, 23.5, right? So you'd be able to put $23,500, approximately that, into the SEP with a maximum of $58,000 or 64 if you're over the golden age, right? The 401k, again, it had to be established last year. It's 100% of compensation up to $28,000. I think that's the number 22, 28, something like that. So essentially, what happens is then if you say you made $28,000, but then you put the 401k, then your wages get reduced to zero. The owner or the company, which is you as well, gets the benefit or the deduction of the amount that they contribute. It's dollar for dollar 401k matching, and then there's profit sharing as well. Now, be careful with the 401k. I always recommend this if you do not have employees, but if you have employees, you have to also you have to contribute to their 401k as well, right? So you don't have to worry about with these ones, but the 401k you also have to, if you have employees, you have to contribute to the employees as well. That's why I always try to recommend using independent contractors instead of employees. If you only have like one or two or three people helping you out, always try to go with independent contractors because you don't have to offer them benefits or 401ks or anything like that. So you can see these contribution amounts are a lot higher, right? The HSA is completely something different. If you know that you have a high deductible health plan, you probably know that you can get an HSA. If you don't know about these things, reach out to me. I'll send you a video on HSAs and high deductible health plans and if those are right for you or not. But like I said, it's usually if you have a high deductible health plan, you know that, or you pick the health plan that you're in specifically to get the HSA benefit. Most people are doing that kind of thing, right? Okay, So now we covered those. Let's go back to the Roth. Now, the Roth is a little bit different because the Roth does not give you a deduction this year. You still have the deadline of 415, but it's really important to understand that the Roth is different from these other ones because the Roth, you're not taking the deduction now, but you get tax free growth. So I want to go take a minute to explain this because there's a lot of misconceptions and a lot of just kind of like bad information that's floating around there. So what I did is actually I went ahead and made a chart here, so you can actually see side by side what the difference between a traditional IRA, which is tax deferred, versus a Roth, which is tax free, and it grows tax free, and you can take it out tax free. So what I've done here is made a couple of assumptions. Now, this is based on $5,000. Now, this is just putting $5,000 in once. I looked at this and I'm like, well, that doesn't really make any sense. No one really does that. So I'm going to go and close that out. I'm just going to, there's too many numbers here. So I'm going to just like this. Okay. So here's my assumption. So the assumption is that we put $5,000 into the IRA and the same $5,000 into a Roth. However, you can see that the Roth number is different. Why? Well, because we had to pay tax on that. So essentially, the Roth number is 35% less than the IRA number because we have to pay taxes. So this is assuming that you're, let's say, at a 24% federal rate and a 10% California rate. Now, your rates are going to differ. Not those don't exactly match up, but I'm just using it for example purposes, right? So basically, I wanted to show you here just the math is. Oh, actually, wait a second here. Hold on. Okay, sorry about that. My math was wrong. So if we're doing a 35% tax bracket, that's what we're assuming. Yeah, 35 combined tax bracket for the years 1 through 30. And essentially what we're saying is that we're going to be paying $1,750 in taxes on that $5,000 because the Roth is right, we have to pay tax on the Roth. So essentially we're paying 35% in taxes. So net after taxes, we're only putting 3,250 in, where the IRA we're putting 5,000 in because tax deferred, right? You get the tax deduction or tax deferment on this year. So what I want to do is actually run through this over the next 30 years. Now, if you access this sheet and you notice my numbers here, I actually have this growing at an 8% rate. Now, I'm not a financial advice, I'm not the financial analysis person. I can't tell you, what stocks to invest in that's going to get you 8% a year. I can't guarantee that you're going to get 8% a year, all that disclaimer stuff that you have to do essentially, right? But essentially, this is the assumption that we're making, is that you're putting in $5,000 a year, or in the Roth, in the case of the Roth, 32.5, and that it's going to grow at 8% every year. All right, so you're putting in money and it's growing at 8% with the compound interest. So what's going to happen is we're just going to take this out for 30 years, right? So if you're 30, you're going to be 60. If you're 40, you're 70. If you're 50, you're 80, right? And then what we're going to start doing is then drawing out after that 30-year period. So basically, I have to start with year 30 and then draw it out for 30 years. So what I want to do is show you the difference on this. Now, I think these numbers are really important to note because here at the end of at the end of 30 years, you have 566. Okay, here in the tax deferred account. Here you only have 368. Now, what's interesting to note is that the longer that you put it in, the more it's growing. And the more it grows, the more compound interest you get. So if you I'm not going to do it, but if you look at the difference between these two amounts and these two amounts, you'll notice that this one is growing more because there's more money invested. Not double, but more than half. Okay. So you can kind of see the difference there. So now let's talk about taxes. So what's going to happen in 30 years now that we want to draw this down or start taking this out? So what I want to do is give you this example. What we're going to do is take out $50,000 a year. And when we take out $50,000 a year, you can see that that's going to last us the whole 30 years. And by taking out the $50,000, we're taking out a total of $1.5 million. So it's interesting because we grew it to 566. However, what's interesting to note is that because we have a larger balance here, it's still earning 8%. right? It's still earning. So even if we take out $50,000 a year, it's not going down. Our balance is not going down by $50,000 a year because it's still growing based on that compound interest. Okay. So you can see here that the difference between 566 and 561, it's only about $5,000. So that means that at the higher, when you have $500,000 invested and it's growing at 8% a year, then it's making like $45,000 a year. So most of this is interest that you're taking out and a little bit to principal. So that's interesting to know. So let's look at the tax brackets. So when you take out the $50,000, you've got to pay tax on it. So right now, our lowest tax bracket is 10%. So you'd basically about paying about 5%, or sorry, $5,000 or 10%. Not bad. 15%, 7.5, 25%, 12.5. So you can see as your income bracket goes up, and you'll go up. So what's going to happen is if you so this is really set up for people that are working and they work for 30 years and then they retire and then they basically build it up and then draw it down. It works really well. And that's what it was originally designed for. But if you are going to be growing your wealth and increasing your income and increasing your tax bracket, then the traditional may not make sense because you can see that as you increase your tax rates, you're paying more in tax. So even though you had more and your more money grew more, you're paying more in taxes because you're taking it out, whereas the Roth does not. So that being said, can we say the Roth or the I or the traditional is better? No, it's just different. It depends on where you see yourself in 30 years. If you see yourself in 30 years as, having a multi-million dollars or having 250,000 to $400,000 or more in income, and you're going to be at a 25% tax or higher, well, by all means, like the Roth makes sense because then it's growing tax free, whereas you don't have to pay tax on this, right? Also, if you plan to pass on your traditional, just know that whoever you pass it on to has to pay these taxes, whereas the Roth, they don't, right? Because you took the tax break and benefit here, you can't pass it on as tax free. Whoever you pass on the traditional to, they have to pay taxes on this and whatever their bracket is. So that's also an interesting thing to know. So if you go all the way down to the bottom here, I guess I could kind of like uh, minimize these because you don't really need to see year over year over year over year what's happening, right? So basically what we're doing here is you can see that we drew this down to about $29,000. And I'm only showing you on the traditional. I'm not going to show you the drawdown of the Roth because it doesn't really matter. So here you can see that by taking $50,000 a year, we actually took out over just actually exactly $1.5 million. Don't ask me how that works, but that's kind of the way it works. It worked out to a very specific number there. And then we can see here, assuming that your tax bracket is 10%. Now, of course, can you assume that your income's not going to go up or down, or your Social Security, or you have investments or dividends or other things like that? No, I mean, that can go up and down. We can't guarantee that you're going to be at a 10% rate for the next 30 years. Also, rates could increase as inflation increases, right? So there's no guarantee to what these rates are going to be over the next 30 years. And remember, we're not talking about the next 30 years. We're talking about the next 30 years after that. So basically, let's just say it's 2020 to make the numbers easier, right? So that's 2050 to 2080. Hopefully we're all in like flying cars and yeah, flying cars by then, right? So yeah, I mean, who knows what things are going to be like in 2050, right? Who knows what things are going to be like in 2080? So that's essentially what's happening is we're looking at like no idea what's going to be happening in the future. So you can kind of see that if you had $1.5 million and you paid 10% on that, that's 150,000, 225, 375. So if the brackets go up, well, by all means, you're going to be paying more in taxes. That's where the Roth looks better. So here I actually did the net numbers, right? So the 1.5 million minus the 150, so you get 1.35 net, 1, 2, and 1, 1. So you can see here, this is the net after taxes. So the net after taxes of the 1.5 million that you got, and then these are the rates associated with it, right? So I'm going to bold these I'm going to make these bigger, and I'm going to put boxes around them so you can kind of see this is this is this is what we're looking at. I'll put it green, right? Because we're talking about money. Hopefully that's not too bright. Okay, so that's kind of what we're looking at for that, right? So the Roth, it grew to one, just a little over $1 million. So I didn't show the math for that, but essentially what's happening with the Roth is we're assuming a similar drawdown over 30 years and with no taxes. So I think the Roth drawdown was about $35,000 a year, right? I put it over here. So the Roth drawdown is about $35,000 a year. So that's interesting to note that with the traditional, you're getting 50,000, but with the Roth, you can only draw down 35, right? $35,000. Okay. So that's the difference, right? But now what we can do is compare this Roth amount to this amount, and you can see that if you're consistently at the 25% tax bracket, but after that 30-year period, for the next 30-year period, if you're at the 25% tax bracket, these numbers are not that much different, right? Only $120,000. And I mean, it's still like 10%. It's still, a little bit of money, but over to 60 years, uh, you're right. You can kind of see how these two amounts are very similar. But these two amounts are very different, right? The spread or the difference or the margin between the million and the 1.35, almost $350,000, quite a big difference there, right? So you can definitely see how taxes eat into the profits or the net that you would get with the traditional versus the Roth. So that wraps up the video, right? You can see the assumptions, $5,000 a year, 35% combined tax bracket, 8% growth for that 60-year period, consistent growth, right? No ups and downs or anything like that. We have no idea what the stock market's going to do if you invest in the stock market. But yeah, so a couple key takeaways, and then I'll end the video. So a couple key takeaways is the more money that you put in, the more you're going to be paying in taxes. It's also the more you're going to save. The higher returns that you get will make the Roth better. So you can see that based on these numbers that I gave you right here, right, the traditional looks better, to the tune of $300,000. But if you invest into, let's say the next Bitcoin or the next Dogecoin or something like that, which you can do in an IRA if you self-direct it, which I can talk to you about if you have questions about. But if you get into an alternate investment like that, or if you put into land and your land grows, 10x, 20x, 50x, 100x in value, where you're not just taking the standard 8% a year, slow growth of the stock market of 8% a year. But if you get into something that grows crazy, well, by all means, you want to be in a Roth, right? Because you can see that if you hit the higher tax brackets, this margin starts to deteriorate. So I can't figure out the break even exactly, but you can kind of see it's probably going to happen somewhere between 30 and 35%. So if your tax brackets grow, right, which means inflation is happening, or the tax rates increase, or you have more money, you're wealthier, you have more income, all these things, right? These are all impacts to whether or not you want to do the traditional or the IRA. I think these are really important, right? And who knows, like what's going to be happening in 2050, right? I don't know what's going to be happening in 2050. We could all be like flying around in flying cars for all I know, right? But it's important to kind of get an idea of where you're going, and if you plan to invest into things that are going to be growing uh, quite rapidly, right? You're going to want to be in a Roth. If you're like, hey Jake, I'm going to throw it in a stock market, S&P, Nasdaq, whatever, just let it sit there for the next 60 years, right? Then you might want this more, I don't want to say conservative, but more just consistent, right? It's very consistent. Whereas the Roth, like I said, I mean, if you can get $1 million Roth, then and get it out tax free, wow, that's pretty great, right? So yeah, I hope that kind of gives you something to chew on when you're thinking about putting money into a traditional or Roth. Um, Now you could say, Jake, I'm completely confused. I've just listened to you for the past 20 minutes. I still have no idea what to do. So I'll tell you what, you don't have, you can do both. as long as you're under the income limits, as long as you're under these income limits, you can actually put money into, you can put 3,000 to the IRA and 3,000 to the Roth, and that way you're protected on both sides. If you do something great, in a great investment in a Roth, and it grows and it, you know, balloons, and you can take out a bunch of money tax free, hey, you're great. And then if you don't, then you're like, hey, I'm still hedged against that. I still did the IRA, and I still, had some tax savings. So if you're totally confused and you're like, Jake, I don't know what to do, just do both. Or if you're like, hey, I think I really want to do this year, but maybe I'll do this next year. Well, yeah, by all means, you can do that too, right? And then you could just do IRA this year, Roth this year, IRA next year, Roth this year, next year, right? You go back and forth if you wanted to as well. Just because you choose one thing this year does not mean you're locked into that forever. So the most important thing is that you're educated, that you understand what's going on, you understand your options, and you're not ignorant to it. Because if you're ignorant to your options, then you don't do anything, then by all means, like, you're not going to do anything and nothing's ever going to happen. So if you use what I've explained to you and taught you here, and you can say, yes, I'm making the conscious decision to put away some money this year, and I'm going to make this my wealth building strategy, so I'm going to have $500,000 at the end of by 2025, in the next 30 years, by all means, that's your wealth strategy. Can that change down the road? Of course, right? But we need to have a trajectory right now. You need to have something that you're thinking about, so that you can move your wealth and your investments going forward, right? So thank you so much for listening to me for the past 22 minutes. That's a whole episode of TV, but I think if you compare it side by side to a 30-minute TV show with commercials, you learned a lot more here. So thanks again for your time. Really appreciate it, and I will see you on the next video.